Hey everyone, welcome back to the channel for another great one this week. This week, you guessed it, it's on the screen. We're talking about index funds. These are some crazy good investment vehicles. I cannot emphasize this enough to you guys. And this week, we're going to take a better look at them and kind of see and show you guys into the depths of exactly what they are, how they're constructed, and how you can see exactly what each one is holding, and how you can even replicate it yourself if you really wanted to. So let's dive into this one. It's a great one. Let's turn you guys into millionaires and let's get going. Hello everyone and welcome back to the channel. Today we're taking a look at the true value of index funds and how you yourself can become wealthy using the power of index funds. Now let's start with the term index fund. It's thrown around pretty often, but today we're going to jump deep into what they are, how they work exactly, and why you should ultimately incorporate them into your portfolio. So first off, let's start talking about the name, the actual name index fund. An index fund is not always an exchange-traded fund or ETF. It can also be in the form of a mutual fund that's tracking an index. Index funds that are ETFs tend to be more cost efficient than mutual funds, and they have lower overall MERs or management expense ratios, and typically have no sales load as mutual funds have, which is a commission charged when we are buying into the fund. It's very important to distinguish between the two kinds of index funds for this reason. Additionally, we should also check to see which ETF providers are themselves associated or in part mutual funds. The name can be very misleading of the actual fund itself. Some providers that are strictly ETFs and not mutual funds include providers like Vanguard, Fidelity, and Charles Schwab. ETFs are also commonly referred to as passively managed index funds. Since the inception of the idea for an, quote, index in the late 1800s, with the Dow Jones Industrial Average being the first, and the S&P or Standard & Poor's 500, which came a little bit later but still in the 1800s, they've been using the weighting, and it has been in the form of market cap weighting. This means that larger companies overall hold a larger proportion of the total fund's value. The market cap is, as we know and looked at before, is calculated as the price of shares multiplied by the number of outstanding shares of that company. So this method of weighting soon was seen to have issues when this was used first off. Some of these include the over-concentration of large and, importantly, overvalued companies, and smaller companies were seen to be undervalued and therefore underrepresented in the funds. And this was quite a problem. So from this shortcoming, there came the idea of equal weight indexing. The technique gives equal weight, as it sounds, to all index fund holdings. This allows equal representation irrespective of each company's market cap. Let's start by taking a look at market-weighted indices. Typically, index funds, which are in the form of ETFs, are market-weighted indices, as we've said, which are also known as MWIs. These often include the ones you are holding in your portfolio right now. They're the most common type. So their weights within the index are in part determined by their market capitalization. And this is done in this manner right here. So we take the market cap of the company in the fund, it can be any company, and we divide that by the market cap of all companies, the sum of all their market caps. Multiply it by 100 and we get the percentage of the pool to which the company is allocated. So for example, let's say Apple trades at $100 per share and there are currently 1 billion shares outstanding. So Apple has a 100 billion market cap, which is that $100 a share multiplied by the billion shares outstanding. And if the total market cap for the S&P 500 fund, for this particular case, for all 500 of the companies is $1 trillion, Apple makes up 10% of the pool. This is how it's calculated. So $100 billion, which is Apple, divided by the total weight, which gives you 10%. So this calculation is then done for each and every company. The current top 10 companies in the S&P 500 index make up almost 30% of the index, which there we can see where the problem stems from. So now we can take a look at equal weighted indices. So if we don't end up liking the idea of large companies representing a larger proportion of the overall index, we can take a look at equally weighted indices, or EWIs. An example of this is the Invesco Equal Weights S&P 500 Index Fund, ticker RSP. These types of funds equally distribute the weighting regardless of the size of the company, as we've mentioned, amongst the constituents of the fund. It does this so that each represents 1/500th or 0.2% of the pool, all being equal. Now, doing this allows for protection from crashes in tech, for example, because it doesn't have that concentration at the top, but it does expose investors to underperformance from smaller and less established companies, which have equal weighting to those large ones. So the choice is really yours as the investor. Do you want more or less exposure to smaller or larger companies? Which one of these do you choose? Pick and choose and use that to determine what kind of weighting you want in your portfolio. However, some data also suggests that there is a higher risk through the means of a higher standard deviation for equally weighted funds, with 17% versus 15% for the MWIs. So a little bit higher variance and standard deviation. So what does it mean for you? It's come to fruition when you put your hard-earned $1,000 or $10,000, whatever your case might be, into an ETF index fund. Taking a look at SPY's top 10 holdings, and we need to keep in mind that SPY is a market-weighted index in this case. And again, it's just an index fund. And here we have those top 10 holdings. So if we take a look at the top 3 holdings and take $1,000 invested as an example, the top one is $60.40 of that, which is Apple, $55.60 into Microsoft, and $23.20 into Amazon. So there you go, those are top three there. Now the rest of the $1,000 is then invested similarly into the remaining 497 companies as per their weights. So this is how it works when you invest in an index fund. Now, if you're determined, you can sit down and use the percentage-based holdings that's shown on the website here, and with those 10 holdings and all of them, we can create our own index in our portfolio with no management fees. But in Canada, however, trading fees will quickly eat away any savings from this, since there are still trading fees, and it will offset the expense ratios by far. And another drawback of this method is that you'll have to manually rebalance every single quarter, whereas an index fund actually does this for us. It gets rid of underperforming companies and incorporates promising companies back into the fund. It's important to mention that most brokers now also offer fractional shares. And this is very important because we can buy whatever dollar amount we want and need. And when we buy a certain dollar value of an index fund, it's automatically diversified for us. And this is the key. And it's based on the holdings of the fund itself. And this is regardless of the total shares purchased, but rather the dollar value. But why would we buy index funds and not just go straight to the source and buy the actual index itself? This is the big question. Why do we need index funds? Wouldn't doing this eliminate management fees since we're going right to that index anyways? This is a good question, and if you're wondering it, it's a very good question. So we're actually unable to buy the index itself. It's physically impossible. And this is because it's a measure of performance strictly. So Standard & Poor's, for example, they manage the index but does not take investor funds whatsoever. Therefore, we need an index fund to recreate the movement and make up for the index. Alright, so now let's tie this together. What is the verdict here? Since their inception in the 1960s, index funds have gained international traction through their focus on low cost solutions for investors. And they do this by buying and setting them up for success with their portfolios in doing so. So there's thousands of different index funds to choose, and some are based on the following things. So geographical region is one of them, consumer trends, industries and sectors. There's even some for types of markets, types of assets, and niche fields as well. This is just a small proportion of what's available. Some even think outside the box as well, such as Global X, which is another ETF provider. They have a custom ETF lineup. For example, their ticker BOSS invests only in companies where the CEO is also the founder of that company. Very interesting. The possibilities are endless, and it's where you get to be a little bit creative in creating your portfolio. So the purpose of index funds was to provide diversification for average investors, and again, that low cost aspect, in order to make investing less costly and easier for everybody. So I'm telling you, harness this power. Once we have a general understanding of index funds through this video and the other we have on our channel, you should know how to find what you like and know which ones are low cost, and then do a couple comparisons and add them to your portfolio. So if you have any questions, please leave them in the comments below. We'd be very happy to answer any questions you guys have. Have a good one. So now before we end today's video, we're just going to go ahead and take a look at our results. If you guys remember from a few weeks back, last month, we took a look at ChatGPT and what it can do for our investing portfolios. We actually gave ChatGPT a prompt to build us a portfolio, which we did. We showed you guys how we built it. And so now we're just going to do a little checkup, see how it's doing. It's been a month, so let's see how our returns are doing. So let's dive into it. So let's take a look at our portfolio that ChatGPT built for us. So here down below, we can see all the tickers that we were prompted to buy through the commands in ChatGPT. So we've got Apple, Amazon, Berkshire Hathaway, Cisco, Goldman Sachs, Johnson & Johnson, Kellogg's, which I replaced. If you haven't seen that, check out our video from about a month ago. It's about 3 videos back now. And you can get kind of a rundown of what we did and why we switched that out. We've got Meta here, Microsoft, Procter & Gamble, and Visa. So since we did this, we have actually increased our position quite significantly. So in total here, we're up 4.5% in the course of a month. It's fluctuated a little bit. If we look at a month here, you can see we got as high as 107,000, which is about 7.5%. And we kind of went as low as like 104,000. And here's from inception, we can see it started at 100,000. So quite a good increase. It seems thus far that ChatGPT has not let us down, made a nice return. If you did invest 100,000, that would be a nice monthly income, if I'm honest. So very interesting. I'll keep you guys updated on this. We'll do like a little monthly review of how this portfolio is doing, and we'll see if in the long run this holds up. So yeah, thanks for tuning in. This was an interesting exercise to try at home.